I'm Camilla Jeffs from SteadyStreamInvestments, and today we're talking about the 3 ways to fund your passive investment. So at SteadyStreamInvestments, a little bit about our company. We are on a mission to help investors build wealth by investing passively in multifamily syndications, which is a fancy word for group investments. We're really trying to help others do this because it's a method that I found several years ago, and was so excited about the way that we can build wealth and still maintain our time. And it's especially powerful for busy families. So if you have a busy family like I do, this is a really great method for you to have financial peace of mind and eventually leave a legacy for your family. So today we're going to talk about a couple of things. So one, we're going to talk about, of course, the 3 ways to fund a deal. And then we're also going to figure out how to determine which method is right for you. We're going to be discussing those things. So let's move on to the 3 ways to fund a deal. So this is a question that you're going to get asked if you decide to invest into a group investment. On the PPM, which is a private placement memorandum, which is this giant legal document, you will be asked, are you going to invest as an individual? Or are you going to be investing jointly with a spouse? Or will you be investing as an entity? So let's talk about that. As an individual, you're investing as yourself, right? So it's just you. You're the only one who's signing the documents. And typically you're investing with cash into the deal. And so it's fairly simple, right? If you decide to invest jointly, which a lot of my investors do, they'll invest with a spouse or a partner. That means that you both have to sign the documents and have both of your names on those documents. And then the other way to invest is as an entity. So there's several different entities that you could invest with. One is you can invest as a trust. And I've had investors do that before. So that's an entity that you have set up previously with a lawyer, and it's a trust document that has all of your information in there. But you can definitely invest as that trust. You can invest as a business. So I've had investors ask me before, they say, Camilla, should I set up like an entity, like an LLC? Do I need an LLC to invest? So you can do that. And we'll talk about the pros and cons of doing that here in a minute. So you can definitely invest as a business, or you can invest with your retirement accounts as long as they are self-directed retirement accounts. Okay, so those are the 3 ways that you have to decide when you are approaching an investment, which way you're going to invest. So let's talk about kind of the pros and cons and things to think about as you invest. So number 1 is an individual. So benefits are it's pretty quick, right? Like you can manage it yourself. You don't have to check with someone else. There's not extra paperwork that has to be done. There's only the one signer, just one person signs. The distributions will just go straight to your personal account. So in that PPM document, we ask you to fill out your information for your bank. And where you want those distributions to go. So it just goes straight into your personal account. And then also all the tax benefits, they'll flow directly to you. And then you can go and send them to your CPA and have your CPA file for that. A couple of things to consider though about this is that when signing the PPM, there's nothing in there that has anything to do with like asset protection or who will be the beneficiary of your assets, right? So you need to be meeting with a lawyer separately outside of this investment to determine what happens to you if you were to pass away or get disabled or things like that. So keep that in mind, right? Because you have to, if you don't have something in place, you don't have a will or a trust or things like that in place, then your state will take care of it, and it could go to probate or things like that. So keep that in mind, that if you need some asset protection, you got to get that done outside of this investment, because there's nothing in this investment that spells out what happens to you and to your investment if you were to pass. Also, communal law could still apply. So although you are invested as an individual, But say you're married and you're investing as an individual, you're not going to put your spouse on there. And that's fine. I have a lot of investors who do that. But just keep in mind that if you were to pass, then it depending on the state that you live in, communal law could apply, meaning that your spouse would have right to your investment that you made. Okay, what about joint, right? So jointly with a spouse. So with us, when you're signing jointly with a spouse, it's relatively quick. We have a portal that you can sign into, and you just simply review the documents, and the first person signs. And then once the first person signs online, it's all online, so you don't have to go anywhere and sign a physical document. Then it sends an email to the second signer that, hey, now it's your turn. So the second signer jumps in and looks at it and signs. So not that much slower than an individual, although it does require both of you to log into the portal and sign the documents. The distributions will also go to a personal bank, right? And so a bank account that has joint owners, it has both of you on that, that's where the distributions would go. And then tax benefits will flow to both of the partners. And so these can be done, and if you're filing jointly, then it's very simple. If you're filing separately, you need to talk to a CPA about how to distribute those tax benefits. So again, same things to consider: asset protection, how to determine the heirs, and what happens with the asset if you were to pass away. But because the investment itself does not spell that out. Finally, there is an entity. Okay, we talked about the couple of different entities, and I've had investors do all sorts of different ones. So we've had trusts, we've had LLCs, and we've had self-directed IRAs, solo 401ks, etc. So there's all sorts of different entities that you can invest in. So benefits of this, there typically is just one signer. So on a trust, for example, it would be the trustee. So just one person needs to sign. LLC is the same. You can't have a dedicated manager, so only one person. Even if the LLC, I've had families before that have formed an LLC to invest together, but only one person really needs to sign that, whoever is the manager of that entity. Asset protection is typically already spelled out for you, right? So if you're investing as a trust, you have the asset protection that's spelled out in your operating agreement, or OA is what is an abbreviation for that. Also, the heirship is determined by the OA. So you do have that asset protection that is spelled out in your agreement already if you're investing with an entity. So no need to go get something extra or different if you're doing it this way. The distributions, however, have to go to your entity. One of the mistakes we see is that investors will invest with an entity, but then in the section where they're putting in their direct deposit information, they will put it to go to a personal account. So we cannot do that. It has to go to the entity, and you have to use the entity's tax ID number. You cannot use your own personal Social Security number. So every entity will have its own tax ID, and that's what you'll need to put into the documents for this investment if you choose to invest with an entity. Things to consider. So if you are using a self-directed IRA, for example, which is a very, very powerful way to invest and to really increase the way that you do your investments, right? To really kind of benefit you in the long run for your retirement. So a self-directed IRA, the company who holds the self-directed IRA almost always has to sign for you. So you don't get to sign the documents yourself because they are the ones that is managing your self-directed IRA. And to protect the tax protections that are in there, we want to make sure that you don't have any input into it. Right? So you'll be able to tell them which investments you want to do, but you don't control the money going in and out of the account. The self-directed IRA custodian does that for you. So they will have to sign the document. And sometimes this gets it gets tripped up a little bit just because it's not a quick process. It's not like a joint signer or an individual signer who they can just sign really quickly. It typically takes a week or two for all the information to flow back and forth between us and you and the self-directed IRA custodian. So you want to make sure that if you are going to invest with a self-directed IRA, make sure you get on top of that, because typically you only have about 3 weeks to fund the deal. And so we want to make sure that you get into the deal and you don't miss that deadline. Now, you also need to check with your custodian to see what kind of fees and rules they have. So some of them will just have a yearly annual fee. Others will have a setup fee, but then they'll have a fee for every time you make an investment. So just check on that and just make sure that you understand the fees and the rules with your provider so you can follow those and you're comfortable with them. Remember, returns are going straight to the retirement account. We don't want you touching that money at all, so we can protect all of those tax benefits that you get by having a self-directed IRA. So the returns will flow directly to the retirement account. You will never see them in your own bank account. Now, keep in mind that you actually don't get much benefit from depreciation or loss if you're investing with a self-directed IRA, which is a huge benefit for those investing as an individual or jointly with a spouse. But then also there could be an extra tax called UBIT, so the unrelated business entity tax, right? Or the unrelated financial and development tax. So ask a CPA about this. You want to make sure that you fully understand the tax considerations in a self-directed IRA. Now, you're going to make plenty of money in using your self-directed IRA. And there's, of course, but it's a tax protected asset that is investing into a tax protected asset. So of course, there's going to be some little nuances in there, but make sure you talk to your CPA about this so you fully understand and go in eyes wide open about what's going to happen. Okay, so now let's talk about how we're going to determine which method is best for you. So we like to think about this as a kind of a decision tree. So think about cash flow and equity. Are you looking for cash flow and equity now, or are you looking to have that later? Right. So if you're an individual and if you want cash flow now, then it's not a good idea to use a self-directed IRA, for example, right? If you want it now, it's better to use cash and invest as an individual so you can get access to that cash right away. Same thing with tax benefits, right? Do you want that now, or do you want that later? And that will help determine whether or not you're going to invest jointly with a spouse, an individual, or you're going to invest as an entity. And then the last one to consider is the asset protection and heirship. So again, when you're investing with an entity, it's already built in. But if you're investing as yourself or jointly with a spouse, that is not built into the investment. So you definitely need to keep that in mind. Okay, so that's what we went over today, just short and sweet, like always. And so if you're ready to learn more, again, at SteadyStream, we have all sorts of educational things for you to grab. And then if you're interested in investing, so one of the most important things is to join our investor crew. And then you'll be able to have a 30-minute strategy call with me. And after that, you'll have access to the opportunities to be able to invest. And again, I'm here to help you every step of the way. I'm happy to answer questions or, just help you through this process. Thanks for joining, and we'll see you next time.